Welcome to our first quarter overview for the debt markets that we are currently participating in. This is an exciting component of the business, and it's a little bit opposite of what we look at when we're doing a traditional real estate deal.
Yeah, I mean, normally when we're doing a real estate deal, we're like, how do we get reasonable leverage with as low as interest rate as possible with a reasonable amortization? When we've realized that the markets really had very little of that to provide to us and to other borrowers, like, well, maybe we should start lending out there and seeing what we can get.
Yeah, we look at our business as a whole. On the transaction side, everything in the first quarter was very low on the volume of deals. And what that entails is then banks really aren't getting payoffs. Banks aren't cycling their capital. So then they are also by default a little bit tighter on what they're doing just because there's fewer transactions. In many of our segments that we operate in, there was almost no transactions. So that just leads to a much tighter market. And we are now on our 9th debt deal. So we've done 9 pieces of debt, and we've done these across really 3 tranches of like activity that we're engaged in. The first one was a lot of our development deals that we've done where we're literally doing land improvement deals. We are lending money into that. The borrower is then going out and performing those improvements, and we're getting paid current on it.
Right. And the development deals are really in 3 stages, right? It's like you get a raw piece of land that's not entitled. So the first stage is entitle the land, meaning get the proper zoning. Stage 2 is now you have the proper zoning. Let's work through the kind of paperwork to construction. That's probably the easiest way to explain it. And then phase 3 is actually breaking ground and doing development work. So we're lending at all stages of that. We prefer kind of that middle one, meaning that they already have the land purchase, they already have the zoning, and we're really just helping them get through construction because at that point, it's the most bankable for a traditional lender to come in.
Yeah, but at each point, it's really either a starting or an ending point for a piece of debt. So we can come in and then we can exit at each one of those. That's kind of when we think about our typical real estate deal, it's like we're going to come up on the loan maturity. And it's like, hey, are we staying or are we going? That's really what's happening at those points in the deal. And we're seeing like, do we want to put more debt into this or do we want to exit our debt position?
Right. And so the most recent example of that is the Stephenville deal we did with Cole. And he had the land basically fully entitled, fully zoned. And our loan was going towards horizontal development, meaning putting in the roads and utilities. So when I was out there 2-3 weeks ago, there were 9 pieces of heavy equipment, maybe 10 pieces of heavy equipment, just tearing up the ground, getting ready for utilities and roads to go in.
Yeah. So that's one piece that we're looking at. The other piece we're looking at is what we kind of call our corporate credit component. And we did a deal with Discount Lots. That's one of the first pieces of debt that we did where we loaned them money, and they are a real estate business. They go out and they procure larger pieces of land, smaller pieces of land, divide those into lots, and then sell them. So they're turning capital fairly quickly on their end. We did a loan through that structure, and it's been going very well. We've been getting paid off as they kind of cycle.
Yeah, it's been 15 months. I think we lent on roughly 60 pieces of individual lots, and I believe 20 to 25 of them have been paid off. The other ones are performing and paying us routinely, and now we're teeing up our next deal with them to really launch over the next month or so. We'll share that with investors when we get that one package together.
Yeah. And our third component that we're really looking at is someone has bought a physical piece of real estate, and we are providing that first position debt into it. So we've done that on 3 different deals.
Right. So we've done 2 of our own. One of them was our loan was coming due, and it was I think it was 15-16% leverage loan. So we decided to go out to our investors and basically raise private capital for that loan. And another one we did was we sold a multifamily deal, and the buyer was not using any debt, but he needed some construction proceeds to renovate. So we lent to him on that, just really for the construction draw. So it was an unlevered piece of real estate we got first lien on.
And we lent less than 20% of that value. And it was a deal we owned that we sold, so that it worked pretty well. So all of these deals, of the 9 we have, they're all making monthly distributions. They're all current. We have a little bit different ways that we are checking up and ensuring each one of these deals is performing, again, because it's not like a piece of property we own. 2 of them we own, but like the others are other pieces of property. So we're going out and we're seeing what's happening on site. We get frequent reports. We get pictures and videos of how everything is going. So that's how we're keeping track of is this deal progressing? And then obviously we're looking at, are they paying the debt on a monthly basis? We can make our monthly distributions. So.
Yeah, and so let's talk about for a minute kind of how we underwrite and how we price these deals. Like, what does like a typical debt package look like? So when we're talking, all the loans that we've done have been kind of an arm's length transaction, meaning that we know the borrower, we have a relationship with them, we know their business, and then we dig into the deal itself after we get to know them, and at that point we evaluate, okay, how do we position ourselves in the stack? Do they have a lender already in first place? Are we coming in second? Do they have no loan at all and really just a lot of equity in the deal? And really, in what stage of the life cycle of the project are they in? And then we look at really interest rates and where they are today. What makes the most sense for the deal, what makes sense for us as well. And so we're typically lending in call it the 8 to really 16% range. I know it's a really wide range, but it allows really everyone to kind of win, depending on the specific deal.
Yeah. And it's been going really well.
Mm-hmm.
So we see this segment continuing to perform as long as there's kind of like the market transaction volume is lower. Banks are still pretty tied with that without a lot of deal turnover. And then just kind of like the world in general right now, it seems like this a little bit of up and down turmoil. So that's really led to uncertainty leading to indecision.
Right.
And therefore, I mean, that hurts the business where we're going out and trying to buy stuff because it's much harder to do, but it helps this segment. Our debt offerings are really the opposite of the regular cycle of real estate. So that part has been good for this.
And all of our loans have been put in place either on an existing cash flow asset or even on these development loans. Their terminal point is to get to a point that they have an erected building that cash flows. So the goal on all of them is to have cash flow. The development ones are a little bit early in that stage. And as really the deal progresses, we can stay in the deal as we can re-underwrite every step of the way, or we can basically take an off ramp. But if banks aren't back in lending, we can just stay in the deal and keep really cycling with them.
Yeah, and we're excited about doing that with these. So going forward, looking at the rest of 2025 of really where we see opportunities in this, it's two fronts. One, we're going to work on the discount lots opportunity with kind of what we call our corporate credit component of it, and seeing what we can do there. On another round of funding. And then also we're looking at, if we were to sell some of our deals, are we able to step in and be that kind of like piece of seller financing for a mostly cash buyer that's coming in? We did that on one and it's worked out really well. And we're looking at that on another one as well, on the townhome deal that we're looking at doing that with.
Yeah, and I would say add a third piece on there, that as our loans come up for maturity, does it make sense for us to basically raise our own private capital and pay off the loans like we did with Dixie last year?
Yeah, we have our Amberwood Apartments loan that's coming up here at the end of the year, and it's only 22% leverage or so.
It's below $1 million loan, and in general, Fannie and Freddie don't like to finance under really $2 million. So we're not looking to really over-lever this asset or even lever it up even more. So we're saying, hey, this is an $850,000, $900,000 loan. Why don't we just pay it off with private capital and keep the project going as it is?
Yeah. So that's where we're at on the debt front. Again, these are all looking to make monthly distributions, and they have to be current paid. We're not looking at debt opportunities where they're not going to make a monthly distribution. So that's certainly one of those things where we're putting our own constraints into how we operate, because we want to make sure we can do a monthly distribution with these loans.
Yep.
That's the purpose of this. And yeah, we're actually seeing these double-digit numbers that we can hit, and we can find good opportunities. So we're not going out and just actively like marketing and taking out ads and that kind of stuff. We're not functioning like that. This is also people that we know, deals that we can get our head around pretty easily and understand and fit into kind of our wheelhouse of where we operate.
Yeah, and additionally, these are deal by deal, just like the rest of our business. We're not doing a debt fund. So when we're talking to investors, like, hey, if you want some diversity in this, go into multiple loans, not just one.
Yeah, there won't be just a big pool where we go out and offer stuff around. Like, that's not how we do things. So sticking to what we do and how we do it. All right, that is our update on the debt side. Again, all of our quarterly reports go out on the 20th, so those will all be in your portal. All of our distributions on the debt side, they go out on the 10th. So they're slightly different timing schedule. Again, all of that stuff is available in your investor portals for it. We're going to do a live Q&A that we'll send out as well. Happy to answer any questions and go through what stuff looks like. That's always a fun conversation to really dig into how a specific deal is performing.
Oh, and don't forget our upcoming Cocktails in Debt that we're doing at the end of May. That announcement just went out, I believe, like yesterday. So I will be getting together Grapes and Grain in Chamblee in Atlanta in a couple weeks and talking about debt. And we're working on getting one of our borrowers to come out and speak to us.
Cool. All right. Thanks for watching, everyone.